Well, happy Wednesday. Unfortunately, mortgage rates are taking another hit. And no, it's not just about China. Bonds got absolutely pummeled overnight. And if you're wondering why none of this makes sense, well, unfortunately, you're not alone. Overnight, we saw mortgage backed securities tank yet again another point. And on top of that, the 10-year Treasury spiked 14 basis points, pushing the yield to 4.44%. And many in the financial world are sitting, scratching their head, wondering what the heck is going on. So, behind the chaos, as of this morning, the new talking point is that China potentially will start selling our treasuries. Now, know that China and many of our foreign counterparts hold our nation's debt in the form of treasury coupons. When a massive amount of treasuries hit the market, like any other security, stock, you name it, the price of that has to go up in order to incentivize new buyers. Now, keep in mind, we as mortgage professionals, real estate professionals, live in long term debt. That is what ultimately drives mortgage rates. Now, the fact that we have this new fear percolating that China potentially will start unloading that debt, we're seeing disjointment within the financial markets, ultimately pushing mortgage rates higher. So, here, let's dive into really what we're seeing, where kind of the market is landing, and ultimately what we could be doing for our buyers and sellers right at this moment. So, as we know, and as I just mentioned, the new growing fear is that China potentially will start unloading our treasuries, which will create an imbalance between demand and buy or and sell, which will potentially exacerbate the problem we have now. Additionally, the tariffs were intended to finance this administration's goals around infrastructure. Everything that they've proposed was to be financed through tariff revenue. Historically, though, when a bill is passed, those are typically financed through the issuance of debt. In this instance, it was going to be issued through tariff revenue. Now, if we're seeing a slowdown in trade, the tariffs, ultimately revenue in, will slow down as well. So the concern becomes inflationary as, hey, if we're going to finance all this stuff and it was going to be from tariff revenue, yet tariff revenue is declining, how are we going to pay for this? On top of that, a slowdown in trade is typically indicative of recession, which again, recession means government spending, issuance of debt, more inflation fear. Additionally, central banks in throughout the world, in instances like this, massive chaos, we see a wide appetite jump in to purchase our treasuries, our debt, if you call it. Unfortunately, in these moments right now, at least, we're not seeing that type of appetite. There will be an auction later this afternoon. Normal, we have them once a month, sometimes twice a month. We'll see what that appetite ultimately leads to. On top of that, the stock market and bond market, historically, when we see this amount of volatility, stocks decline, that money comes over into bonds. As it's typically revered as a safe haven. We're not seeing that. It's as if everyone is going to the sidelines to say, hey, we're going to sit, we're going to wait, we're going to figure this out. So massive disjointment amongst the markets. And what's scary is that this is very reminiscent of the onset of COVID. And at that time, as treasuries were falling, stocks were tanking, mortgage rates were spiking, and then ultimately the Fed intervened. Quantitative easing, dropped rates, and hey, the rest is history. Now, with the friction between the Federal Reserve and the administration, Jerome Powell has been very clear in saying, hey, we're not going to bail out this time, despite calls from the administration. So, right now, there's a lot of growing concern that we're seeing this massive imbalance, and it does not appear that the Fed will intervene at this point, which has caused, again, more volatility. So then that brings to question, well, what messaging should we be bringing to our buyers and sellers? Ultimately, we know real estate is the benefactor should a recession be induced. Long-term investing in real estate, even short-term, has proven to be really immune to the cyclical nature of the market. Yes, interest rates are not ideal, but here, as we continue to find a balance, or hopefully find a balance, or kind of an even ground, we should expect to see a reversion to declining rates. Now, this is definitely an unfolding story. There's a lot that's happening, which is why I'm here giving an update midweek. Know if you're running into challenges, need help in communicating these messages to your clients, yourself, please grab time on my calendar. And as always, subscribe, like, comment. This message needs to be shared with as many people as possible, as we know that it's inducing a tremendous amount of fear and chaos. So let's make it a great day, and we'll catch up soon.